Hi everybody, it's AJ speaking. The following video comprises the first 52 minutes of my just posted 89-minute video to subscribers. The following video comprises a comprehensive financial review of Uber based on the latest financial disclosure. In the part that I will not publish to non-subscribers, I'm discussing a detailed financial outlook for Uber, discuss consensus estimates, implied valuation multiples, price target, share price, projected share price corridor, and trading strategy. I have to do it this way to retain some value for my subscribers. If you find my research useful and would like to get timely and full access to my research, I recommend you go to X and search for @allojo. Visit my profile and hit the subscribe button. For a tiny monthly fee, you get in-depth financial analysis that is purely aimed at improving trading strategies. With that out of the way, I hope you enjoy the following video. Hi everybody, it's AJ speaking. This is a deep dive into Uber and will be a multi-part video series in which we will cover three main blocks. The first one is a financial review, the second one is a forecasting analysis, and the third block is evaluation. In the financial review, we'll try to answer a couple of key questions. What are the key trends in the numbers? What do they tell us about the business? And how can we use this information for forecasting? In the in the forecasting analysis, we'll be talking about the key assumptions, which will lean on findings from block 1. We talk about how these assumptions affect the outcome, and how the outcome, which is the projected earnings stream, aka EPS, earnings per shares, compare against consensus. And then in the third block, when we talk about valuation, we'll be looking at what the company traded at over the last few years, look at the trading volatility, and look at the current trading level relative to the trading level observable over the last couple of months and year. And then at the end, we bring everything together, the forecasted earnings, the implied trading level, aka multiple, to come to a price target. And we will be discussing good entry or exit prices, or if you haven't invested, short entry price. But that will depend on the outcome of this analysis. But before we move on, let's look at some basic stats. So at the time of this recording, the stock trades just under $90 per share. And fairly recently, you can see this over here, almost touched $98 per share. Company is currently valued at just under $187 billion. And relative to the stock market is moderately volatile at a beta of 1.4 times. The PE ratio shown here, based on consensus, is not consensus, on reported numbers, is 15 times, and this already shows you an issue with the numbers in Uber, but we'll dive into this later, and why this number is completely meaningless. And for the same reason, this EPS number at $5.87 is also completely meaningless. The stock is up 48% over the last, year to date. And we will also discuss why that is, and you probably will be able to see it in numbers. So let's dive right in. On this first slide, you see revenue development, and I'd like to point out something down here with regard to the labeling of the x-axis, or the horizontal axis. You can see the quarters, so Q2 25 is the second quarter of year 2025, obviously. But what is this down here? So LTM stands for last 12 months. And for most of this presentation, I will be showing not financial years, which in Uber's case overlaps with a calendarical year. So Uber's financial year goes from January to December. But for valuation purposes and for analytical purposes, it's better to generate LTMs and NTMs. NTMs is the next 12 months. And LTM, as we said, is last 12 months. But then there's the same period prior to LTM. And in this presentation, this will be labeled LTM -1 and analogously LTM -2, LTM -3. This is a slightly superior way to show numbers because it creates annualized numbers from the latest quarter's perspective. And we will be doing the same for forward-looking years. There will be NTM, next 12 months, NTM +1, NTM +2, and NTM +3. The upside is when we look at annual growth rate, we always look at numbers on a consistent basis and in a timely fashion. So let's talk about revenue. So in the second quarter of 2025, revenue was up 18% year over year to 12.7 billion. And over the last 12 months, total revenue increased, so on a 4-quarter basis, by 18% as well to 47.3 billion. And when you look up here the second row is percentages. This is year on year. You can see 18% that I just mentioned for the quarter. Down here you see 18% for the LTM, last 12 months. But you can also see in the prior quarters the growth rate was quite high. You can see that the company in this view, which spans over the last 4 years, the company not a single time grew less than double digits. The slowest growth rate was in the third quarter of 2023, and where the company grew in quotes only by 11%. And you can see also on these annual growth numbers, which are on a consistent basis, as I just explained, grew like a rocket ship in 2022. This was partially driven by COVID. Then 37% the year after, 14%, and then, as we discussed, over the last 12 months, revenue grew by 18%. So first, the key observation is this is a rapidly growing business in terms of top line. By the way, revenue is called top line because it shows up as the first line in the income statement. Next, let's look what this looks like in terms of segments. So Uber has 3 segments. One is mobility, the second one is delivery, and the third is freight. Right now, you're looking at the total revenue generated in the mobility segment. And the mobility segment comprises what you probably first think about when you think about Uber, which means passenger transport via Uber drivers. This segment grew in the second quarter almost 90% year over year to 7.3 billion. But the LTM grew faster, was up 21% to 27 billion. So when you look at the last few quarters in terms of year-over-year growth rate, you can see that this is significantly less growth than in all prior quarters except the last quarter, before the just reported quarter. So Q1 of 2025 saw a 15% year-over-year growth rate, so slightly less than the 90% delivered in the second quarter. But then when you look at the prior quarters to the first quarter of this year and the second quarter of this year, you can see that year-over-year growth was never below 25%. So the second observation is the business is growing very rapidly, but a very large segment, mobility, does experience a slowdown in growth. However, it's still quite high. And next, let's look at the second biggest segment in terms of revenue, that is delivery. So delivery is what the name implies. It's where Uber matches demand and supply for certain products. And obviously the first thing that comes to mind is Uber Eats. So Uber matches people's demand for meals and restaurants' supply of meals. And that business has grown quite quickly. In the second quarter, is up 25% year over year to 4.1 billion. And it's significantly higher than the LTM, which is 20.4% to 15.1 billion, and marks the highest year-over-year growth rate in the last 3 years. The last time delivery segment grew faster was in the second quarter of 2022 at 37% year over year. So the next key observations we can make is that it's Uber's second largest segment by revenue that is driving growth, at least in relative terms, i.e. in percentages, but not in absolute terms. Absolute terms, it means in terms of dollar amount, the mobility segment still added year over year more dollars in terms of revenue. But let's not forget about freight. What about freight? I think the numbers speak for themselves. Freight is not growing at all. This business stagnated or slightly declined for over 2 years straight. The business in terms of revenue peaked in Q2 2020, then experienced a massive drop-off over the subsequent 6 quarters to just under 1.3 billion, and then stayed there consistently until the most recent quarter, Q2 2025, when it came in at 1.26 billion. So absolutely zero growth in this business, and inflation adjusted, this business would look even worse. So let's quickly just summarize what we learned thus far. Overall, Uber is still growing very quickly, but the main segment, mobility, shows signs of slowing. Delivery picked up pace and just announced the strongest growth in quite a while. Freight continues to disappoint and is not a needle mover for the business. When we look at this next slide, the points we just summarized become even clearer. So this slide shows the 3 segments, their respective revenue on a quarterly basis. And you can see there used to be a period when mobility and delivery were pretty much the same in terms of revenue contribution. But then after Q1 2022, there was a clear separation in terms of revenue growth. Mobility took the clear lead. Delivery continued to grow as well, just at a much slower pace. But it appears this may have changed recently. But the largest absolute revenue driver is still the mobility segment. And the freight segment continues to languish. So this next slide shows the segments in terms of relative contribution. So what percent of total revenue does each contribute? In the second quarter, 57.6% came from mobility, 32.4% came from delivery, and 10% came from freight. So freight is still large enough to worry about at 10%, but when you look at freight in terms of relative change, it really is not. By relative change, I mean if it increased by 10%, in relative contribution, it would still only be 11%. And when you look at the long-term trend, over more than 3 years, freight lost importance consistently, sequentially. That means quarter over quarter, with a single exception, and that was the first quarter of this year. But in all other quarters in the last 3 years, its importance decreased in terms of revenue contribution. So that's the end of the segment discussion. Next, we move into revenue by geography. So this chart shows you revenue development in Uber's primary market, which is United States and Canada. Revenue increased by just under 13% year over year in the second quarter to 6.6 billion. Last 12 months, revenue grew just under 17% to 25.1 billion. Again, if we look at the quarterly year-on-year growth numbers, we can see that in the last 2 quarters, there was a significant slowdown in growth. And when we look at the LTM periods, we can see that in the prior LTM period, so in the period from Q3 2023 to Q2 2024, the company already did experience some significant slowdown in growth to just 6.1%. And if you consider that during this period there was also a significant amount of inflation, real revenue growth was basically zero during this time period. However, over the last 12 months, the picture changed and the company delivered just under 17%, so 60.9% revenue growth in this important market. But the last 2 quarters suggest we might be entering another slowdown. But let's look at some other markets Uber discloses. This is next one is what's often abbreviated as EMEA. EMEA stands for Europe, Middle East, and Africa. And here the picture is quite different. Here the company grows quite quickly. Revenue was up 30.5% year over year to 3.9 billion. And LTM increased by 25.7% to 14 billion. So now we know, at least geographically, the primary growth driver. This is clearly Europe. And when you look down here at the annual numbers, you can see the company had delivered consistently for the last 4 years quite amazing growth. But here too, even though growth is still very high, we do see some slowdown, which of course is obviously also expected as you gain size, market penetration. It's just much harder to grow at prior rates. Next, let's look at Asia Pacific. This is a market Uber talks about a lot, but is not really that large, as you can see on these numbers. So in the second quarter, total revenue came in at an all-time high, but this was still only 1.4 billion. Growth was good at 16% year over year, and also marked the highest growth rate in 6 quarters. So it's all good. It's just on a very small basis, and therefore impact is limited. And then lastly, so Uber discloses 4 geographic areas, and lastly, that's Latin America. That is even smaller than Asia Pacific, and here too, the quarter came in at an all-time high, where the company delivered just under 800 million, and here too, growth was 16%. So the interim result of this geographic review is the main market, United States and Canada, is slowing. Europe is providing a significant offset by very high growth rates. Asia and Latin America do grow nicely as well, but they're substantially smaller size, makes them less of a needle mover. So this next chart brings everything together. You see the 4 different geographies. You can see United States and Canada significantly exceeds all other markets. And the important observation here is that due to the relatively smaller size of Asia Pacific and Latin America, even though their growth rate does well recently, you can see that they are not becoming a major segment anytime soon, because the 2 other geographic segments, United States, Canada, and EMEA, just so much larger already. So that's why if you want to assess the growth potential of this company and you have limited time, you're best advised to focus on North America and Europe, because at least over the next few quarters, Asia and Latin America will not move the needle dramatically. A big reason why Uber couldn't penetrate as much these markets had to do with significantly more local competition and also much lower wages, which created a situation where when Uber entered the market, Uber faced off with an existing, let's call it a taxi ecosystem that was already very low cost. So the ride-hailing model, of which the success was built on offering significantly lower rates than taxis, simply was much less competitive in these markets. Conversely, in North America and Europe, taxi fares are much higher, and here Uber could exploit, I should say, take advantage of a lower cost structure and gain quickly market share. And this is another preliminary key observation. Cost to anything that transports anything else, I should say, to people transport, also to goods transport, cost is the key factor. And this will be a point we'll be discussing in more detail once we get to the outlook, the forecasting, and when we have to talk about robotaxis. So this next slide then shows you the revenue contribution by geography. So North America, so i.e. United States and Canada, contribute 51.9% of total revenue, and you can see on the long-term trend the importance of North America is decreasing. Why is it decreasing? And you can see it in front of you. The black line, this is EMEA. That region is just growing much faster and continues to gain importance and stood at 30.8% in the second quarter, a new all-time high. You can also see the, let's call it long-term unchanging nature of the importance of the low importance of Asia Pacific and Latin America. Asia Pacific has been stuck in the just above 11% contribution bracket for a long time with very few outliers. And we can say the same about Latin America, which is stuck between 6 and 7% for a long time. We now close the geographic revenue discussion, and we will be moving to bookings. So on this chart, you're looking at gross bookings. You can think about gross bookings as the total dollar value that Uber takes in before it pays any of the drivers, before it pays the restaurants for the food. And this is, I think, a really interesting point about Uber. And I think it's worth discussing the Uber business model slightly more from a, let's call it, meta perspective. If you think about what Uber does, it is a company effectively close to the limit in terms of least vertical integration. When you think about the product that Uber provides, and I think the meal delivery is a very good example. If you think about the product that is being delivered, the food, everything is outsourced. The ingredients of the food, the preparation of the food, the delivery of the food. The Uber platform is just connecting the various parties involved, from the suppliers, the manufacturer, aka the restaurant, logistics, to the end customer. But Uber obviously doesn't view it that way. What Uber does is, no, we take in all this money and we pay it out to our partners. They're not employed by us, and it's a very important point for Uber. There were huge lawsuits about this point. For example, our drivers employees by Uber. And for very important economic reasons, Uber vehemently said no, and in most cases they won. So what Uber decided to do is, no, we do not book all this money as revenue. We call it gross bookings. We pay all our not employees, and then what's left, this is what we call revenue. I'm slightly simplifying, but this is what Uber does. And the fact that Uber actually discloses gross bookings to us and thinks it's a valuable metric to assess the growth and scale of the business shows you that I think Uber knows that looking at gross bookings more in terms of traditional revenue would actually make more sense. And the reason why you can quickly see how this makes more sense is actually when you start modeling Uber. Because once you start treating bookings like revenue and you model it like you would model revenue in other companies, the modeling becomes quite straightforward. But in my modeling approach, I did not adopt, or I should say I did not change the terminology Uber is using. So throughout my analysis, gross bookings will be called gross bookings, and revenue lines up with the revenue Uber discloses. I just wanted to point this out to you. Number one, to make you understand what gross bookings actually are. and also point out, secondly, this quirk which is created by this distinction. So now let's look at the numbers. So the second quarter of 2025 came in at 46.8 billion and grew 17% year over year. Now let's quickly jump back to total revenue. You can see total revenue came in at 12.7 billion. And when you compare to the almost 47 billion in gross bookings, you can see total revenue is only a fraction of gross bookings. But before we dive deeper into this margin observation, let's look at gross bookings in terms of segments. First, we look at the main segment, mobility. Mobility booked 23.8 billion in the last quarter, up almost 16% year over year, so strong growth. Delivery increased almost 20% year over year to just under 22 billion. And if you compare this with mobility, you might notice something. So mobility just under 24 billion and delivery just under 22 billion. So this is very close together. But previously, when we looked at revenue, you saw that mobility generates significantly more revenue. And when you think about what these segments do differently, it makes intuitively sense. In the mobility segment, Uber takes in the money for a service. But in the mobility segment, Uber takes in the money in terms of gross bookings, not only for a service, i.e. connecting the delivery with the consumer, but it also takes in the money for the product that is being delivered. But since Uber obviously has to share the money with the driver plus the restaurant, Uber retains a significantly lower margin of the gross bookings in the delivery segment. And that is why, despite significantly lower revenue contribution, the delivery segment has almost the same amount of gross bookings. Now let's look at freight. Freight here, it's a bit different because in freight, Uber does not take in any money that it then has to share with a service provider or goods provider, like in an example of a restaurant. And that's why bookings are very small in the freight segment and is the equivalent of revenue. Now let's talk about gross bookings in terms of margin. And the chart you're looking at is in percent. And what it shows you is revenue divided by gross bookings. And what you can see is that in the second quarter of this year, Uber retained 27% of all the gross bookings it took in. And I hope next I will not confuse people. So if we applied the other thought model, if we think of gross bookings as revenue, Uber's gross margin would be 27%. But because Uber chooses to show these metrics in a different way, it calls what would be in a, let's call it classical business model revenue, they choose to call it gross bookings, and then take out all the cost of revenue and show the residual as revenue. We have to adjust slightly. So what does this gross booking margin tell us about the business? First of all, for the last 2 years, the margin has been quite stable within a fairly narrow range, around the low 26% bracket to the low 27% bracket. So between, call it 26.3% to 7.1%. And it was, the key observation is, first of all, the overall level. And the second one, it has been quite consistent. And only during the boom era, driven by the effects of COVID, Uber's margin rose significantly higher to almost touching 29%. So the key observation here, this gross margin is quite attractive. It's substantially higher than what you see, for example, in the auto business, which on a global average, roughly 19 to 20% roughly. But it's substantially lower than what you see in another software type business. For example, on the high end, there's, for example, Palantir and Meta. They have around 80% gross margin. And there are interesting parallels with the business model of Amazon, excluding AWS. Amazon has huge revenue, but because most of it goes to the product suppliers, Amazon only retains a small margin. And this is exactly what we would see in Uber, but Uber, again, chooses to show the numbers in a different way, and also, as we discussed, for legal reasons, because Uber absolutely does not want drivers to be recognized as employees, because Uber then would have to provide typical employee benefits. That's the trick here. Next, let's look at gross booking margin, again defined as revenue divided by gross booking by segment. And you can see that here in the first chart, in the mobility segment, in the main segment, Uber's margin is just over 30%, 30.7% in the second quarter, and this margin has been quite stable for several quarters. Didn't expand really, but does currently register at the high end. The margin in delivery is significantly smaller. It is just under 20%, came in at 18.9% in the second quarter. But I think this should also be expected because, as we discussed, Uber takes in a lot more money from a delivery trip because it pays the driver plus pays the restaurant for the food, the good. So it only makes sense that the implied margin is significantly less. Next, let's look at the freight gross margin. As we discussed earlier, in freight, gross bookings and revenue is the same. And that's why the margin is almost exactly 100%. Another reason why I'm quite interested in gross bookings is that it's one of the two metrics for which Uber provides next quarter guidance. I think this is circumstantial evidence that Uber, I think, deep inside also knows that gross bookings actually is revenue economically, because they could also give us some revenue guidance, but they don't do it because gross bookings is the number that matters. So what do you see in front of you? In front of you, you see for each quarter not what was delivered in terms of gross bookings, but what the management guided for. So for the next quarter, Q3 of 2025, management is guiding for, and what you see is the midpoint. They always provide a range, as you will see in a second. The midpoint, so if you just take the average of the low and the high end of the range, the resulting number is what you see on this chart. And for the third quarter, they guide for 49 billion, and that would be up 19.5% year over year. And that would be the strongest year-over-year growth rate in over 1.5 years. So again, business is growing quite nicely. But let's look at how accurate management's guidance actually was. So this chart shows you the, let's call it guidance corridor implied by the low end and the high end of the stated range, stated by management. The red line shows you the low end and the green line shows you the high end. And the black line shows you the actually delivered gross or reported gross booking number later. And you can see that gross bookings, with very few exceptions, almost always stayed nicely within this corridor with a slight midpoint outperformance bias. Rarely the company delivered close to the low end. In most cases, it delivered closer to the high end. But broadly speaking, it was slightly above the midpoint. So we take the midpoint as a reference point. And then we move to this next slide. This slide shows you the midpoint of the guidance relative and then compared to what was actually delivered. So whenever this blue line is above this zero line, there was outperformance. And whenever this blue line was below, it did underperform. It was so the actual reported gross booking was below the midpoint of the guidance. And you can see that in most cases, the company delivers above the midpoint of the guided range. And these dashed lines show you the average and the median for the last 8 quarters. There's some graphical glitch here. For some reason, it doesn't show the last 8 quarters, only 4 quarters. But the point is, the company tends to report gross bookings about 0.6% to 0.7% above the midpoint of the guidance. Later, when we get to the forecast, my Q3 modeling is calibrated for exactly that outperformance. Calibration means I set the assumption so that the result would exactly deliver this kind of outperformance. So I take management's guidance and I set the assumptions that the resulting gross booking in my model for Q3 will deliver a number that is 0.6% above midpoint of guidance. Next, let's look at trips. And I will just read to you the definition the company provided, what trips are, and then I will give my definition of trips. Trips represent the number of completed consumer and delivery orders in a given period. For example, UberX share ride with 3 paying consumers represents 3 unique trips, whereas an UberX ride with 3 passengers represents 1 trip. I think you can simplify this and you can just say trips represents number of payers. This is a metric, as far as I could see, the company only once provided guidance on, and subsequently only reported the actual number of trips. That's why this metric is not that useful for forecasting, because management doesn't give us their expectation of trips. However, trips are useful in assessing the average value of a payer. But since we don't have a geographic disclosure and important segmental disclosure, it significantly limits its utility for forecasting. But just for completeness sake, I wanted to show you this metric disclosed by Uber. Next, we move on to gross profit. Gross profit increased 20% year over year in the second quarter to just over 5 billion. This is a new all-time high for Uber. Last 12 months, gross profit was up almost 20% to almost 19 billion, which also represents an acceleration in year-over-year growth relative to the prior 12 months period. The resulting gross margin came in at 39.8%, which is a 47 basis points improvement year over year, but it's down a tiny bit, 1 basis point, so basically stable quarter over quarter. And this gross margin improved on a LTM basis 45 basis points to 39.7% compared to the prior 12 months period. So key observation is profitability looks good, gross profitability that is. Next, let's jump to operating profit. So operating profit is after you deduct from gross profit R&D expenses, marketing, sales, and various other. And gross profit is important because it tells you really about how strong the core of the business is. And in this chart, you can quickly see that Uber has only been operating profitable for 9 quarters. And the most recent reported quarter, second quarter of 2025, was the now all-time best quarter with operating profit at 1.45 billion. And that is up 82%. And when you look at these growth rates, forget first quarter year-on-year, it's up 614%. That's obviously a crazy number that results from a very low, depressed year-on-year comparison. But you can see how the economics, how they quickly changed in Uber, going from loss-making to generating over the last 12 months 4.5 billion in profits. And that is up 124% compared to the prior 12 months period, where Uber generated 2 billion. So this significant improvement in profitability was really driving Uber's share price, and that's why the stock is up almost 50% year to date. Let's look at this in terms of margin as well. So this is the operating margins. Operating margins, operating profit divided by total revenue. And operating margin has now increased to 11.5%, obviously a new all-time high. This is still not a great operating margin, but it's a substantial improvement. So what we see in Uber share price is a expectation that this margin is likely to improve. And a big part of that expectation is found in this chart. You can see here operating expenses. Operating expenses have been flat for basically 3 years. And that is basically the story about Uber and why investors like the stock. They basically see this highly software-driven company that has a certain operating expense base on which it can grow revenue without meaningfully expanding its operating expense base. This is basically the thesis. So when you look at these numbers, so in the most recent quarter, operating expenses came in at just under 3.6 billion. Last 12 months are up just 4.2% to 14.3 billion. After they were down 4.3% in the prior 12 months period. That shows you that operating expenses were basically flat for the last 2 years, at least. And when you look at the prior years, Uber even brought down its operating expenses. So really, I would say this is a really positive trend in the numbers, because as we saw earlier, the size of the business significantly increased in terms of both gross bookings but also revenue. But still, the company, and despite the significant inflation that is also that also hit the company during the periods that you see in front of you, the management kept operating expenses basically flat, is very good and quite impressive. But let's look at it in terms of operating expense margin. So you take operating expenses and you divide by total revenue. And this basically confirms what I just said. Despite the growing scale of the business, so the revenue was growing, the operating expenses were flat. The result of the two in terms of margin was then obviously that the operating expense margin came down. And you can see this fairly consistently. Margin came down year over year. And you can see this up here in the second row. You see the change in basis points, and you can see these numbers starting from the first quarter of 2022 on a year-on-year basis were always negative. This means there was always an improvement year over year with one single exception, and that was in the fourth quarter of last year of 2024, where there was a 59 basis points increase. So this is a really positive trend. Next, let's look at operating expenses and what was keeping them flat. So first, let's look at operations and support. So this is part of operating expenses. The numbers in front of you are in billion. You can see this stayed fairly flat for, call it roughly 2 years. This chart shows you the same metric, but again on a relative basis, relative to revenue, and you can see how spend on operations and support continuously decreased. For example, in the most recent quarter, of every dollar of revenue, Uber spent 5.5 cents on operations and support. Next expense bucket within operating expenses is sales and marketing. Uber spent 1.2 billion in sales and marketing in the second quarter. So this is a little, let's call it choppy trend, but broadly speaking, it's also kind of flat for the last 2 years. And you can see here again the relative perspective. In the second quarter, Uber spent only 9.6 cents per dollar of revenue on sales and marketing. This is substantially lower than it was a couple of years ago, where, for example, if we look back at the second quarter of 2022, 3 years ago, the company spent 15.1 cents per dollar of revenue on sales and marketing. But you can see that this margin trend is or has been flatlining for several quarters. So it seems like Uber had to ramp up its marketing efforts, which then set off the benefits from the increase in the size of the business. Next, we get to research and development. Uber spent just over roughly 840 million on R&D in the second quarter. This is an all-time high, but still overall, Uber spends relatively little on R&D. And this is what you can see in this next slide. So in the second quarter of 2025, Uber spent 6.6% of revenue on R&D. This is for a technology company a rather low value, and is quite close to what certain automakers spend on R&D. And what you have to keep in mind is always the situation in Uber about gross bookings and revenue. If you used gross bookings as the revenue number, this percent would be significantly lower. So the 6.6% would be only around 1.5% of gross bookings. In other words, I think the key observation is it doesn't seem like Uber is pushing very hard on the R&D side, and was more focused on keeping operating expenses low. Next, let's look at general and administrative expenses. They too stayed quite flat, with the occasional outlier driven by certain one-off items. These outliers were significantly driven by certain legal expenses, but we will not dive into those aspects because that will make this video series way too long. And then again, the relative perspective, Uber spent on general and administrative expenses only 5.3% of revenue, and that too is a all-time low. This next item is a slightly odd one in terms of disclosure. Is depreciation and amortization, and Uber reports it in operating expenses. I will not talk too much about this because big picture, it's not too important for investors. It's just another kind of quirk in Uber's reporting. But you can see this charge. An important thing about this item is it's a non-cash item. So it only is a deduction from the P&L, but then in the cash flow statement, you add back that number. And you can see this charge came down quite meaningfully over the last few years, but has now roughly flatlined around the $170 million mark per quarter. Next, we leave operating expenses and we move to non-operating items. This is something I'm not going to spend much time on. This is the area in the P&L where Uber books all most of the one-off effects, and you can see a couple of them in this long-term trend. But they are not important for our forecasting, so we are going to move on. Next, you see the net result of everything we discussed this far. This is profit before tax. And you can see the profit before tax came in at 1.5 billion in the second quarter. This is not all-time high. And the reason is there have been certain one-off items in Uber's reporting history on a GAAP basis. And this is a problem, and we'll be discussing in a second why that is a problem. But first, let's look at reported shareholders' net income. Here again, I think it's even worse. You can see in the second quarter, shareholders' net income was just under 1.4 billion. And this is significantly less than the almost 7 billion delivered in the fourth quarter of 2024. And that is actually a giant problem for valuation, and we'll discuss in a second why. But let's first talk about what happened in the fourth quarter. So there was a 6.4 billion benefit from a tax valuation release, and another 556 million benefit pre-tax. due to unrealized gains from certain equity investments Uber took. The reason why there's a big problem is what you see in front of you. So, now you see earnings in terms of EPS. So you take shareholders' net income and you divide it by diluted shares outstanding. You get to the EPS numbers that you see in front of you. So Uber reported 63 cents for the second quarter, but had this giant reported EPS of $3.21 for the fourth quarter of last year. Normally, what companies do, or quite often I should say, especially amongst large companies, they give you an adjusted number. So what they do is they take out large one-off items to give you like a more underlying view of the business. Uber doesn't do that. Uber doesn't provide adjusted EPS, or sometimes called non-GAAP EPS, which is typically the same thing. And they just show you EPS based on what's reported on a GAAP basis in the P&L. And the reason why it's a big problem is this makes the reported EPS by the company completely unusable for any kind of valuation work. This means you have to make adjustments. However, there is one thing that we can use to mitigate that problem, because luckily Uber does provide adjusted EBITDA. So EBITDA is earnings before interest, tax, depreciation, amortization. And in this adjusted EBITDA, they make all the adjustments that you would like to see on an EPS basis, or at least shareholders' net income basis. So what we can do is we can use the adjustments disclosed in the adjusted EBITDA disclosure, and we can apply them to the shareholders' net income to derive an adjusted EPS number that reflects all the adjustments that are one-offs. And in Uber's case, I think that's by far the best approach you can take. And the reason is that most of these adjustments, they are not disclosed in any of the notes in the SEC filings. So if you don't take this approach, you cannot adjust the net income. And then you cannot derive an adjusted EPS number. And then you're left with an EPS number that is completely boosted or depressed by one-off items. And that's like a huge no-go in evaluation, because the resulting multiples, they would be all over the place. Alternatively, so people who listen to this and know about valuation, they would say, hey, AJ, why are you doing this silly approach? Why don't you just use enterprise value to EBITDA? Then you can use adjusted EBITDA. That is a valid point, and is a point I thought about a lot, because I thought I might be doing share price projection on EV/EBITDA basis, because you can do it in the same way as I do it on a PE basis, because all you need for an enterprise value is you need a debt and a cash projection, and then from there you can back out the share price. Because what you would do, you would forecast the adjusted EBITDA, you would work out the trading level based on that metric, so you would work out the historical enterprise value development, the reported next 12 months adjusted EBITDA, so you can work out a true EV/EBITDA multiple, take that multiple, apply it to your forecast adjusted EBITDA. That would give you a forecast for the enterprise value, and then you deduct from this forecast enterprise value your forecasted debt and cash. The residual is then the market value of the equity, and the final step would then be to divide that number by the forecast number of shares outstanding diluted, and that would give you the share price. So you can do all of that, but ultimately, especially given that the company moved to profitability also on a shareholders' net income basis, the fact that for a lot of people who listen to this, PE is a lot more intuitive than enterprise value to EBITDA. And third, and most importantly, I make all the adjustments to earnings that are reflected in adjusted EBITDA. I basically cherry pick the best from both worlds, the simplicity of the PE plus the higher accuracy from the adjusted EBITDA number, and bring it all together in an adjusted earnings number. And what this looks like is what you see on this chart. So what I've done is I've adjusted for historic periods all the way back to the first quarter of 2022, the reported EPS for all the things that Uber disclosed in the adjusted EBITDA. So what Uber does, they show you the operating income, and then they show you a bridge to how you get to adjusted EBITDA. And that bridge shows you all the line items they adjust for. And then all you need to do is you need to do, obviously on a consistent basis, add back or subtract certain of these line items to get to the adjusted earnings number. I will not go through the details of these adjustments, because this would make this video way too long. But the outcome of this exercise is what you see in front of you. And what you notice, this earnings stream is actually not jumping all over the place. It looks quite smooth, and the company has a fairly consistent trend in its earnings generation, and that trend is upwards. And this is what you would expect just by high level. You see the revenue is growing, the operating band space stays fairly flat. So just intuitively, very high level, this is what you would expect. But because all the stuff that's going on in Uber's disclosure, all these one-off effects the company is not adjusting for in the GAAP numbers, you get to this very messy earnings profile. So the earnings stream that you see in front of you, but of course for the forecast periods, will be the basis of our valuation later. And next we'll be discussing adjusted EBITDA. On this next chart you see Uber's adjusted EBITDA as reported. Second quarter was up 35% year over year to 2.1 billion, and the LTM was up 41% to 7.5 billion. So the adjusted EBITDA number gives you a good idea of sort of the earnings improvement in the business, and this was driving the share price this year. You can see year-on-year growth rate very impressive, and second quarter was the 15th quarter in a row that saw sequential earnings improvements. So a really strong earnings performance by Uber, no doubt about it, and that's why the market value in the company soared so significantly. So on this next slide, you see the outlook management provided for the third quarter. Management is guiding for 2.24 billion. What you see in front of you is the guidance midpoint. But let's move right on to the guidance corridor of the adjusted EBITDA. And this chart works the same way as the same chart for gross bookings. The red line shows you the lower end of the guidance range, and the green line shows you the high end of the guidance range. And unlike the guidance for gross booking, which nicely fitted into the corridor, the reported number nicely fitted into the guidance implied corridor, the reported number is not typically within the guidance corridor. That's the key observation in this chart. You can see actually that up until very recently, the company always reported above the high end of the guidance range. In fact, you can see that only in the fourth quarter of 2024 and the first quarter of 2025, adjusted EBITDA came in below the high end of the guidance range. The company never missed as defined by falling within the guided range or above guidance, i.e. it never reported below the low end of adjusted earnings. This is a key observation, which tells us, number one, by the time Uber provides next quarter outlook, it has a high degree of high visibility for that quarter. Uber typically reports about 5 weeks into the ongoing quarter. So its outlook at that point is only for the roughly 7-8 remaining weeks of that quarter. And when you think about the type of basic service Uber provides, it's not a surprise that once you have a sufficient scale or size, that forecasting accuracy improves significantly. So in practical terms, what this means when you try to do some forecasting, you should always err on the upside. And this chart now shows you the outperformance over the midpoint of the guided range, and you can see it's quite significant in some quarters, but they lie far in the past. Outperformance was quite dramatic, exceeding over 50%. But in the more recent quarters, there was always outperformance. First of all, it's a key observation here, and the outperformance with median and average around 3.7% was also quite substantial. So to get to a better reference point, we should be using the high end of the guidance range because of the company's consistent outperformance. And when we do that, we get to this chart. So this chart is the same exact analysis. It compares the high end of the guidance range with the actually delivered number. And you can see that with two exceptions that I mentioned earlier, Q4 2024 and first quarter of 2025, Uber always exceeded the high end of the guidance range. And here you can see the metrics. Outperformance was always around 0.6% median or 0.9% on average. For that reason, my forecast is also calibrated to that level. In the most recent quarter, second quarter of 2025, the company came in right on guidance in terms of high end of guidance range. You may call this, there's a certain, let's call it underestimation bias, or you might call it sandbagging. This next chart shows you the adjustments Uber makes to operating income to get to adjusted EBITDA. You can see there are some significant outliers. We will not dive into each of these. This would take way too long. So we move right on to the next topic, which is share count. So this is an important topic later for valuation because Uber started to generate quite significant free cash flow. The company also just announced 20 billion authorization for share buybacks. And given that the market cap is only 180, 190 billion, a 20 billion share buyback does make a meaningful impact on EPS, because the more shares you can buy back on a relative basis, the more of an EPS boost you get. But of course, here in this historical observation, we can't really see this. The share count stayed, let's call it relatively flat with a slight dilution, and you can see this down here. So over the last 12 months, there was a decrease in share count from share buybacks. Share count decreased by 1.1%, but in the prior years, different story. Share count increased in the prior 12 months period by 3.4%, and in the prior period to that period, 5.6%, and so on. So my forecast, and I'll discuss this in more detail when we get to the forecasting section of this presentation, fully reflects ongoing capital return to shareholders. And my modeling assumption is that all excess cash flow goes to share buybacks. Since we are talking about share buybacks and free cash flow is essential for share buybacks, let's look at the free cash flow generation. You can see this has grown quite significantly. Second quarter of 2025 came in at just under 2.5 billion, which is really a good number. Last 12 months, free cash flow was up 85% to just under 8.8 billion. And this is really driving the share buyback, because basically Uber doesn't have any good investment opportunities. I mean, they can always do M&A, but that obviously depends on whether there's a suitable target. Given the announced share buyback, or I should say authorization, it's a difference. So authorization is just to ask for a certain budget in terms of shares that can be bought back. And then the actual share buyback is a different thing. They might fully exhaust the authorization, or they might only buy back a tiny fraction of what was authorized. And they can change these plans any day. But once a company told the market they intend to do share buybacks and then go back on that outlook, that's highly negative for the share price. So typically management only changes their mind if something really, really important happened. So that's why my modeling fully reflects significant ongoing share buybacks. Now we actually arrived at the end of the first block of this video series, which was the financial review. Quick summary. So overall business continues to grow quite quickly. Gross margin is stable. The company demonstrates good cost control. The earnings disclosure makes it slightly tricky for retail investors to come up with a valuation. Operationally, we see that mobility shows some potentially early signs of slowing. Delivery, on the other hand, has a stronger growth rate, but at a lower margin. Freight is not improving, has been stagnating for years. Geographically, the main market, North America, is somewhat slowing, but the European market does particularly well. Other markets like Asia Pacific and Latin America are not really needle movers. Now we move into the forecasting analysis.